Well, I figured I'd take today to elaborate a little bit more on the real ramifications of yesterday's stock market decline and what the broader context is, because I didn't really have a chance to get into yesterday what beyond the Wu flu is threatening this market and why we've been in a very precarious position here for quite some time. So the Wu flu itself, if it were just the Wu flu, I wouldn't be that concerned in the long run, about the stock market. Because if you think of it, just in a pure sense, if we have this perfectly fine economy and then the Wu flu comes along, what's it going to do? It's going to disrupt supply chains, which is going to be very bad in the short term. But eventually, we would expect, unless this, truly is an apocalyptic disease, that eventually those, whatever supply chains become disfigured, will eventually be repaired once the shock of the virus subsides, and then things will get back to normal. If you think of it like a still pond of water, and you throw a big stone in it, it's going to make a bunch of waves, but then, pretty quickly, the water's going to return to being, calm and still, as long as there's not anything else under the surface that could contribute. Like say you threw that rock into the pond and you hit a gator on the head, and then he jumped up and made a bunch of other splashes and tried to attack you. Well, in that case, then you would have a little bit bigger problems if you're in that pond than just the splash made by the rock. And so in this case, that gator under the surface of the water that we need to worry about is the massive market bubble that was created in the wake of the 2008 crisis as a way of trying to replace the housing bubble and to, create some new way of inflating asset prices in order to reflate the economy. And I've gone over this before, but the basic way that this scheme worked was that Ben Bernanke, as the chairman of the Fed, pumped money into, by lowering interest rates, by printing money, and essentially diverting funds into the stock market by encouraging people to buy stocks when things were really low back then and nobody really wanted to buy stocks, to reinflate all these people who still own stocks, reinflate their portfolios so that they no longer, because what happened, after 2008 is that if you had, a bunch of money in the stock market, you lost a good chunk of that, and then all of a sudden you felt poor because even though, you have no less money in the bank, your assets that you own are worth less. So you have to be a little more careful with how much you spend. You might be saving more every year, to try and recover those losses. Well, Bernanke wanted to minimize those losses and make them go away as quickly as possible. So by dumping money into the stock market, people's portfolios went back up. Their net worth returned to pre-crisis levels, and then they felt okay, going out and being profligate spenders again, which, is not great in the long term, but in the short term it will boost GDP if people are spending more money. And so this led to people going out and buying brand new cars and taking more vacations and doing stuff like that. And so the Fed has maintained this by keeping low interest rates to ensure that money keeps flowing into the stock market and that the market keeps going up. And when they tried to unwind, all of this and start, letting the balance sheet run off, meaning all of that QE money, taking it back in and burning it, taking it out of circulation, and also, raising interest rates so that, things like, car loans and home loans cost a bit more because you had to pay more in interest. Things started to come unglued, if you don't remember, a couple of years ago. And so that's why 2019 was characterized by the Fed lowering interest rates again, because the Fed found out that this economy can't survive without that, those constant liquidity injections, and that's how we got to the point to where we are now, to where, rates are now back below 2%. I think they're at, maybe 1.75%, the Fed funds rate, and the Fed is doing, permanent open market operations, and daily repo operations where they're just injecting billions of dollars of liquidity into the market every day to keep things afloat. Because without that, not as much money would flow into the stock market. People would become more concerned about fundamental issues that we have in our economy, like absurdly low growth and an absurdly overextended market capitalization to GDP, meaning that stocks are very expensive right now relative to the size of the U.S. economy. And so the price of stocks would begin to come back down to earth, back to what their more natural price would be in the absence of Fed intervention. But if that were to happen, the entire economy would come unglued, because if people's portfolios, if their net worths, fell, well, then they wouldn't feel as wealthy, and they wouldn't be spending as much money, and so they wouldn't be consuming as much. They wouldn't be buying as many new cars, and certainly not new houses or second homes or third homes. And then this would lead to cuts in certain sectors. And considering that we have a massive corporate debt bubble that was created by these low interest rates, all these companies are so heavily indebted that if they don't meet their expected targets for sales, if people aren't consuming as much, well, then they're going to go bankrupt, and their bondholders are going to take a haircut, and the banks that lent them money are going to take a loss. Well, then that leads us right back into another financial crisis. And so what does this have to do with the Wu flu and what happened yesterday? Well, like I was saying, if the stock market goes down, substantially, and a sell-off starts, because the seeds are there. Stocks are by the objective measures that are used, considered overvalued. The only reason why prices are as high as they are is because people keep buying them. And of course, that's how all markets work. There is no objective value when it comes to things, but we do have some objective metrics for determining whether a stock is a good deal or not. And so if there isn't constant positive pressure on people, if there isn't this sense that prices are going to keep going higher, then people have no reason to buy. The only reason why people are buying now is purely because of speculation. They're speculating that because the Fed is being so strong in supporting markets, that markets will keep going higher despite all of this. But if markets go down despite Fed intervention, then all hell will break loose, because people will realize that, hey, stocks can go down. And so, the short-term damage to supply chains done by the Wu flu outbreak may very well be something strong enough to break that psychological grip that the Fed has on markets. And, if they go down in the short term, is what I'm saying, is that because we have such an unhealthy economy to begin with, they won't just come back up, naturally when the supply chains are repaired, because the thing is that we're way above, sort of where the natural price would be anyway, ex any Fed intervention. We have so far to fall to get down to where prices would be, in the absence of Fed intervention, that the effects of this Wu flu thing on the economy are going to be, much stronger than they would be by themselves, because you're going to have this pancake effect. And so I think the next week and a half, 2 weeks, maybe even this week, in the stock market is going to be very important to watch, because we need to see if people quickly bounce back from this whole Wu flu thing, and if they buy, because we had a huge gap down yesterday of like 100 points on the S&P. If the market is able to quickly regain all of those losses and go ahead and make new highs, then perhaps this whole Wu flu crisis, wasn't enough to scare the market sufficiently to where they no longer trust the Fed. They didn't break their faith in the Fed. But if we have a weak bounce back like we do so far today, I looked at futures before I started this, and they're only up about 13 points on the S&P, which is nowhere near, recovering for yesterday's 112-point loss or something. Now, of course, we still have all day to go. Perhaps, it'll get up and they'll recover 70 points, in which case, we may very well be on the way to a full, filling of the gap. And once that gap is filled, there's still the possibility of whether at that point, whether we'll see another sell-off or whether we'll see a rally to new highs. And now there won't be any sure way of telling whether the market's confidence in the Fed is truly broken. It's going to be subjective. But that's what, if I'm one of you, it's certainly what I'm going to be watching, is trying to see how exactly, the market is affected by this and how it bounces back. I expect if things get any worse, the Fed is going to cut rates right back down to zero, but they're already doing, QE. So they don't have much ammunition left. Considering that last year every one of the Fed's rate cuts were sold, meaning that stocks went down after the rate cut, and they only rose in anticipation of the rate cut, I'm not too optimistic that the Fed is going to have at this point, if they cut the rest of the way back down to zero, that they're going to be have much of a positive effect. The only thing that really seemed to save the markets before was their return to QE, which of course they're not calling QE. But considering they're already doing that, and the market is pricing it in as QE. The Fed can call it not QE, but if the Fed came out tomorrow and said this is QE, now we're doing full QE, I don't think it would have much of an effect, because most people seem to recognize that QE is already ongoing. So they've already, I guess, blown their load on that one. I don't know, maybe they can do more QE. But either way, every time that the Fed capitulates and gives up more ground and wastes more of its ammunition, that's less that it has to use later. And so eventually, it's going to be worn down enough to where it just can't support this market anymore. And that, the way things are going, that may very well be before the election. There is a leak out, I believe, to NBC today that Trump is very concerned that the Wu flu is going to sink the economy before the election. And that seems to be why, he's trying to, tamper down on all the news of it in the United States. Of course, the U.S. hasn't reported any new cases, in a couple days, and they're reporting them sporadically, and they're also not testing people very much. There's only been 400 or so tests conducted in the United States. There's probably, some people floating around who should have been tested for it and have it, but haven't been. And that probably, in the long run, is going to bite the U.S. In the butt. Because whoever those people are, if they're floating around, in the ether, they're going to spread it to other folks. And, if and when the Wu flu really does gain a foothold on the North American continent, specifically in the United States, and we start to see, triple-digit case numbers here, I would expect another sell-off of this magnitude, in the stock market. And again, if the Fed wastes all their ammunition on this current sell-off, well, then that next one they won't be able to do anything about. There's only so much that the Fed can do. Sure, they can go to negative rates, I guess. That's unprecedented. It hasn't worked anywhere else. Of course, in Japan, once they went negative, they never came back. If you bought stock, if you bought the Nikkei in 1991. You're right. You're just about right where you were then. You haven't made many gains, but you certainly haven't beat inflation in the Nikkei. But as I've said before, at least in my area, stagnant stocks like they've had in Japan, that's not going to cut the mustard. We need rising stocks, or else people are not going to be coming out and spending more money and buying second houses and going on vacations to the Florida, as the Northeasterners like to call it. Retirement, of course, nationwide, will be a thing of the past. But who knows, if the Wu flu comes through and culls, many of our elderly, perhaps our inverted population pyramid won't be, so severe, and the Social Security system will be saved. But that's a pretty grim upside. So I'm going to continue to follow this, and I'll probably have another video discussing the whole market situation this week. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.